Assalamu alaikum everyone. Welcome to Chicago Muslim Women Professional session on the investment principles with our value investor Hajara AlAmodi. Today we're going to talk on the investment principles as per the value investment. More about the speaker. Hajara AlAmodi is an investor. She's currently a lecturer at the University of California, Berkeley. She's also a founder and chief in charge of AlAmodi Avenues, investment and the business valuation advisory business. She has spent her career at the intersection of technology, project management, and investing. She's also a founder of a software services company based out of US called the AlAmodi Corporation. Hajara ran large-scale technology projects for companies in IT, transport, finance, and services. So she's on the board of many international companies in finance and venture capital and the private equity, e-learning, e-real estate, education and research, such as Vivacity Global in Nigeria, Comfort Home Builders in India, and Tekuluku in USA, and Red Parrot in USA, and Faster Capital in UAE. She has been recognized as a top director to watch at a private director association in 2019 and nominated on the top 100 people in finance in 2020. So I'm going to hand it over to Hajara. Please go ahead.
Thank you, Sadia. Assalamu alaikum, everyone. I hope you guys are able to hear me well. Can I start my screen share?
Yes, you can. Yeah.
So I don't have to add anything to my introduction because Sadia has done a very good job of introducing me. Quite an extensive intro there, so thank you. So I belong to the investment side of things. I work primarily as a private investor. And this is one of the topics that I think, just is it's not talked about often in our community, especially among the women folk. So I have noticed this again and again, time to time, that this is something that people are curious about. But, I have a lot of messages popping up, but maybe Sadia can, privately talk to some of these members here. So this is one of those topics that I think everybody has an interest in, but just, never really got an opportunity to. Today's session, we sort of designed this to be more like a fundamental one-on-one type of a class where, I'm just going to try to introduce the concept, the idea here to people who are interested. So I'm going to start off with really simple and easy questions, and we could try to kind of elaborate as we get the interest from the audience, and then at the end of it all, we can have a Q&A session for you guys to ask me questions that you may have. So first and foremost, how do we describe an investment? Investment in the most simple terms, it's basically, where you put in an effort in the hopes of getting back more in return. So we talk and use the term investment for a lot of different things. So, we talk about investing our time, our energy, our efforts, investment in education, and things of that sort. And in the world of finance, it's about putting your money to work for you, right? So the idea here with investment is that we are trying to make the money work for us. So we are not working for the money, but the money is going to work for us, and that's what truly an investment is. It's supposed to give you back more in return. The money that you put in is supposed to give you back more in return at the end of the day. And the best investment is obviously the one where, you're able to make that money while you're sleeping without putting in additional effort. Okay, Sadia, I'm just going to go along and kind of, talk about these topics myself. Is that okay?
Yes, that sounds good.
So when we talk about investment, there are categories So we have investment categories, and then we have investment strategies. So there are categories and strategies, but there are also investment philosophies. And all of these are important concepts for us to know as an individual, as an investor. Now, what is an investment category? Investment categories are probably the stuff that you've heard about from time to time on the news. You know, we have CNBC and those type of channels talk about it all the time. The main ones are your stocks, real estate, bonds, cash, and then we also have some other ones like futures, derivatives, commodities, mutual funds, different classes and categories of mutual funds again, index funds. There's something called REIT, R-E-I-T, which stands for Real Estate Investment Trust. Forex investments, so there are forex investments that happen, so this is currency trading basically. And then we have emerging market equities, bonds of different types, government bonds, corporate bonds, CDs. Your banks always try to mark you to different CDs with various interest rates. Retirement accounts, your 401ks, derivatives, options, futures, and all of those stuff are all the different categories that exist in the investment world. Now, most of these, again, they deal with stocks or real estate or cash in one way or another. So, mutual funds, what do we typically have in mutual funds? It's a basket of different stocks. REITs are real estate investment trusts, so they deal with real estate. These are companies that actually hold real estate, and the purpose of REITs is really to collect rents, and they pass the rents to their shareholders. So if you buy a REIT, you're going to be getting a certain amount of rent every quarter, yearly, whatever that may be. But it's a significant amount, but there are tax implications on REITs. But they give out a pretty decent amount of rent. They need to share it with the shareholder, and it's usually like about 85%, 90% of whatever they make as the rental income that has to be passed on to the shareholder. Now, so this is what it is. These are categories. So when we talk about categories, you want to remember, it's one of these things. Lately, we've been hearing a lot about the cryptocurrencies. So crypto is another set of asset class or category. So investors are also putting their money in cryptocurrencies and those kind of things. So these are, more of it's a trend. Right now, it's one of the newer concepts, and, there is a difference of opinion about whether, this is a good or a bad investment, like we always have with all kinds of different investment categories. Now, strategies is a very important concept in investment, but more important, or something that leads to your strategy, is a philosophy. So try to understand this as I'm explaining it. Strategies are the outcome of philosophy. Okay? Now, what do I mean by a philosophy? So a philosophy is basically your orientation. It's your outlook on things, you as an individual, okay? It's to some extent how you have been wired, okay? How, you think and understand situations, how you perceive value, how you deal with stress, fear, apprehensions that you may have, what your perspective is on things, long-term, short-term, how do you handle those uncertain situations? And in investments, we deal with a lot of uncertainty. How do you deal with stock market volatility, the noise, the emotional high and low that you hear from the market through the news? Does that influence your investment decisions? So these are all different elements of having a philosophy. So all of these things will form a philosophy for you. That would ultimately lead you to forming a strategy for how you want to invest, in which category you want to invest, for how much of a time you want to invest, whether you're going to be a long-term investor, a short-term investor, a passive investor, an active investor. The philosophies coming because of the way you have your perspective set, the way you are, oriented, those things will determine the strategy and the categories for you in one way or another. So I'll talk about a few popular strategies, a philosophy, and then a strategy, just to help you understand, what are we talking about here. So one of the most popular ones is a value investment as a philosophy. I am a value investor myself. Now, value investors, they apply a value strategy. Okay, who are these value investors? To better understand this concept, they are passive investors. They are the kind of people who kind of sit in the background. They don't mingle too much or involve themselves too much in the business and management decisions as a business, as a company. So they don't like to butt heads with the management. They're not trying to get both seats so that they can bring about huge changes to the business. That's not their way of working. Okay. There is another set of investors called active investors. Now, active investors do all of these things. They will get both seats. They will try to, change the management. They will try to bring about changes in the organization, in the board, in the CEO, those high-level positions, because they think there is an underlying value in that company that needs to be extracted, and the management is not doing a very good job of bringing out that value. So they're coming. They get a major share, of the company, and then they, get the voting rights through that, and that's how they try to implement a strategy. Okay, so value investors follow a value investment philosophy. They follow a value strategy. They implement a value strategy. So these are the type of investors that they're geared to be like this, okay? So, you're oriented to be a little like this. You are going to want to sit in the back. You're going to try to assess the value of a company. You're going to try to assess, the capability of a company, the viability of that business. You're going to try to assess the management style, the honesty of the management, how capable they are, whether they're delivering the right results for you, whether they are able to make the right investments in the business. So you as an investor, you're going to try to assess all of these things, and you will look at, what's the value of this company in the long term. Is it going up, or is it going to go down, or is it going to be a business that just, liquidates at the end of the day? Whatever that may be. So you'll try to do all of these things, and then you will invest in that company. You'll buy their stock, their share, whatever it may be, for a price. And that price is going to be a cheaper price than what that value is in that business. So you need to assess the value, and then you're going to try to buy that stock for a cheaper price, and that is what value investment is. So that's a value strategy. We're not going to try to engage with the management a whole lot, okay? We're not going to try to get rid of, CEOs or make changes at that level because we think there is value in the company and they're not doing a whole, great job. If that's the situation, we'll try to walk away from that business. We're just not going to invest in those places. We're not going to, become that active investor and try to bring about this whole set of changes because we want that business to bring out the value, thereby, increasing the stock price and all of those things. So that's a value investment strategy that comes out of the value investment philosophy. So then we have growth investments that happen with investors who are growth investors. So this is another category of investors. Growth investment is a philosophy too. And growth investors are people, who like to take a bit more risk. Okay, so what they're going to do is they're going to invest in companies that are still fairly young, companies that don't have a proven concept yet, or maybe they're trying to work out things and they're not just profitable yet. So think of venture capital. So venture capital companies, they are growth investors. They invest in young companies. Seed investors, pre-seed investors are even more risk-oriented investors. So the seed investors, they invest in companies at a very, very early stage. So this is a time when you know, the business is just an idea. Okay? So as an entrepreneur, you go to these investors and you tell them, hey, I have this great idea and I want to, build this product, but let's, give me some money. So the seed investors will come in and help these guys, materialize the idea and get things going. Highly risk-oriented investments, these are, and majority of them fail. 85% of these, the seed investment is lost. But one or two companies might click, and they sort of recoup the entire amount through those one or two companies. And that's the idea with the venture capital funds as well. They're taking a whole lot more risk here with these companies because these are younger companies. They have business ideas, concepts that have not been proven successfully in the market yet. The market hasn't accepted it fully yet. Things have yet to, materialize, and there needs to be validation coming from the market, which hasn't happened yet. But these people are oriented like that. I mean, you would think, right? I mean, why? I mean, when there's so much risk with these kind of businesses, why do you want to invest? Why do you want to put your money here? You're taking a whole lot of uncalculated risk here. But this is how these people are just scared. So, you have to understand this. Investment has a lot to do with your personality type. It has a lot to do with how you look at things. So philosophy comes into the picture when we talk about investments. It's all people game here. We're dealing with people. We're dealing with people's emotions. We're dealing with how these emotions are influenced, and that all determines, how things impact the stock market, especially with the public securities when we talk about the stock market. There is one investor, her name's Kathy Wood. Maybe you guys have heard and seen her on the TV. She runs a fund. It's called ARK Investment Fund. Now, she invests in a lot of technology companies, technology-oriented growth companies. So her investments are mostly in very young companies or, younger companies who are still trying to figure things out, create a right product.
Getting from Costco in big amounts?
Somebody needs to, everybody mail their phones. Go ahead, this is Shreya.
Okay. All right. So these companies are younger companies again. They have more debt on their books, on their financial, balance sheets. They are usually making losses. They haven't started making profits yet. You're going to see this as a trend with these young companies. But it's just that, when these companies click and they start making money, some of them become really, really successful. So when these venture capital firms, the seed investors, invest in these kind of companies, they are really betting on, just one or two. So they're going to invest in like 10 businesses, 10 different companies, 20 different companies, and it's just one or maybe two maximum that are going to be successful from the bunch. Every other company is going to fail. But that one or two is going to be such a big time success that it's going to, make up for all of the other failed businesses that they had invested in. So that's how their mind works. That's how growth investors work, and those are the type of companies they're going to invest in. They're never going to be happy when they see a value-oriented type of an investment. They're not going to be happy applying a value investment strategy where we talk about, let's buy something that already has an existing value and let's buy that for a cheaper price. So buying $1 for 50 cents. Buy and hold is another strategy. So buy and hold is basically where you're buying stocks on a regular basis with the intention of holding it for a really long time, 15 years, 10 years, those kind of time frames. And you could also apply a technique called dollar cost averaging here. So dollar cost averaging is basically where, and this is actually a good technique to apply with all of the other strategies too, where you're going to, say for example, you decide to buy the stock for Google. And so what you're going to do is you decide on how much you're going to invest, right? Say, for example, you're going to invest $5,000 buying Google stock. Now, you don't want to go and get all 5,000 worth of stock today itself. With the dollar cost averaging technique, what you're going to do is you're going to spread it over a time frame. So maybe, buy $1,000 stocks today, and, in maybe another 2 weeks when, due to some market news or market sentiment, the stock price lowers, you buy another $1,000 there, and then, you buy another $1,000 in another month. So this way you're spreading your risk. Risk of what? Risk of buying it at the highest price, right? So you're going to average out here when you do the dollar cost averaging technique. And you want to do this with yourself most of the time. And then we have index investing, fixed income investing. Now, index investing is where you as an investor think that it's a better idea that I just put my money in the entire stock market itself. Okay, I'm not going to pick one or two stocks. I'm not going to decide on, should I buy Google or Microsoft, but I'm actually going to put all my money in equal amounts in all of the stocks that are listed on the stock exchange. That's index investing. Fixed income investing is where you're investing in these fixed income producing assets. For the traditional investors, for what we typically have right now in finance, it tends to be bonds. Okay, but the problem with bonds when it comes to the Muslim community is that they give you interest as an income, as a fixed investment, as a fixed income. But, just for your understanding, these are the different investment strategies. These are the different investment philosophies that lead to the strategies. It does have a huge influence, or is more influenced by, what kind of person you are, what's your personality, and then, how much risk you're willing to take, what kind of risk you're willing to take, those kind of things. So it's a lot about your orientation. And then we'll take some questions later. This might be a little too much for some of us here. Okay, is there a difference between income and wealth? Just a concept when we're talking about investment. Yes, there is. There's a big difference. So income is basically the cash flow. That's how you want to think about income. Income is the cash flow, the cash that's coming in a certain time frame. So income, yearly income. That's your yearly cash flow. So for a lot of people, it's the wage that they earn, the salary. That's the income. It could be the dividends they are getting from your stock investments. It could be the rent you're collecting from your properties. So these are other forms of cash flow. Wealth, the way we define wealth is basically the total worth of all your assets combined. So if you have a stock portfolio, if you have a real estate portfolio, your house, maybe sometimes, I typically don't like to consider the house, when you talk about investments. But everything combined together, that becomes your wealth. The total value of all your assets is your wealth. Now, income leads to wealth. It can. There are a lot of really, high income earning people around us, but not everybody is wealthy. Not all of them are wealthy, because people earn and then they spend and then, they don't really truly think about investing. So it's just like, cash flow coming in and out. But if you have figured out how to invest that income, you're able to convert it into wealth. And wealth is how you build that asset base. Wealth is how, through which you have a stable, safe retirement, and that's how you actually, get the money in true sense for all your future events. It's not the income, because income is not reliable. When I don't know if you guys have ever heard of this one list Forbes comes out with on a yearly basis. It's the Forbes, although they come out with a lot of different lists, but they have this one where they look at all the different people who are the wealthiest in the world. They're actually looking at all of their assets, and and then, figuring out who is more wealthy. It used to be Elon Musk. It was, the Amazon guy for a while, Jeff Bezos, and, it kind of goes up and down between some of these people. But that's the difference. That's the technical difference between income and wealth. Income is your cash flow. Wealth is the total worth of all your assets. Your income does lead to wealth if done correctly. But, the reality is that a lot of high income earners are not truly wealthy people because they just, haven't figured out how to manage their wealth. Okay, now a very important concept. If you haven't heard any of the other stuff I've been talking about so far, at least, pay attention here because this is something that is truly the beauty of investing, the compounding aspect. So Albert Einstein, I don't know if you guys knew this, but Albert Einstein was an investor himself. He was a genius in so many different ways, but he was also an investor, but not a very good investor. Einstein actually said that compounding is the eighth wonder of the world. Compounding is how your money is going to make you more money all while you're sleeping. So this is the best part of being an investment, that you are able to put your money to work. So you only have to make the initial effort, and then everything else is done by the money. So let me just give you some examples to, help you illustrate this concept of compounding and, how things truly change when, your wealth compounds, when investments compound. Google, for example, right? Google is a public company. It has this shares listed on the stock exchange. So Google, if you take Google, and if you had invested $1,000 in Google back in 2004, it would have made you, look at this number, it would have made you $39,000, 361, so 39.61 and 38 cents. So $40,000 today. So in 19 years, you would have had a total return, a compounded return of 3,836%. Just think about those numbers for a second. These are big numbers. What did you do? Did you have to work 8 hours a day to convert that? No. You just invested $1,000 at the right time, and then you just waited patiently for it to compound. So patience is a big thing in investing. We need patience to make our money work for us. But $1,000 in Google would have, in 19 years, given you $39,000. It's an annual return of 22%, and that's a very good return to have on your investment. And all you did was invest that $1,000 back in 2004 and did no other work after that. Microsoft is another example. The reason why I'm using these examples here is because we all know these companies. We are all familiar with their products and services. The $1,000, again, in 2004, same time period, you invested it in Microsoft, it would have made you $15,000 as of today. A 1,412% return over 19 years, which comes down to about 15.82% on an annual basis. Pretty good, right? How did that happen? That was compounding. Your money made you more money, and it made you a pretty significant sum. Berkshire Hathaway, so this is a very good company. It's a conglomerate. I don't know if you have heard of this investor, a very popular value investor, Warren Buffett. He runs Berkshire Hathaway. He's a founder and owner of Berkshire Hathaway. It's a public company again. So $1,000 invested in 2004 again would have given you about $5,000 and change today. 406% return over 19 years. On an annual basis, that's about 9% or so. So compounding does this for you. That's what I mean here. All we did back in 2004 was invest $1,000 in each of these companies, and look what we have today. No other work. We didn't need to get up and go to work or, 19 years. We did nothing after that $1,000 investment, and we still had more at the end of it all. That's what compounding means in finance, in investment. It's a wonderful concept if you truly understand it. There's a very good book called 100 Baggers by a value investor named Christopher Meyer. So if you guys are more curious about this, please read that book, because it actually has a lot of, true business stories illustrating the same concept. Because these are not, one-off investments that have given these kind of wonderful returns. There are many more examples of these types across the globe, not just in the United States, but across the globe. There are many businesses like these. So read by the 100 Baggers if you can. It's a wonderful book, really kind of explains the compounding aspect of finance, of investment in the business world. Compounding also happens in real estate. It happens in all kinds of different asset classes. All good investments can compound. So, say for example, here in Florida, in the United States, between the time frame of 2000 to 2005, house prices in Florida increased by about 82%, after being adjusted for inflation. And so, compared to the rest of the country, they increased by about 31%. Now, we all know back in 2008-9, we had the housing recession where things, really dropped in value. Prices fell, and so Florida homes actually lost a lot of value in that recession. But look at it again. In 2012, so 2 years after that recession was over, the median sale price in Florida for a house was $145,000 in 2012 after the housing recession. And last year, it was about $402,000. So that's 179% increase. And if you're an investor here, which is, we're doing all of these calculations excluding the rent. Okay, so rents are like another, 7-8% per year. So add that on. But this, shows you compounding happens in real estate too. Our job as an investor is always to select the best possible investment and give it time. Time is a precious commodity in the investment world. It can do wonderful stuff for you. Okay? And when you give your investment time, most of them, even if it's a bad investment, most of the time it will turn out okay. But with time, we don't want to panic, and we don't want to sell when, it's low and, it's been hit by the market sentiment. Those are times where you want to, hold on, ride it through, and wait for that time when, the prices come up again. Austin, Texas is another example, and I think all of us have heard and have been hearing about Austin for, ever since COVID started. But over the past 5-6 years, the prices increased by about 99% in Austin. At the peak of, the housing craze, so that was, even early last year, Austin just had about 0.8 months worth of inventory. So that's like 5 weeks worth of houses. Okay, houses that could be sold in 5 weeks. That's all the inventory they had. It was crazy. Average price of a single-family house in Austin was $84,000 in 1990, and it was $557,000 in 2022. So it multiplied itself about 6 times, 7 times over. And we have these kind of examples in other states too. South Carolina, New York. New York was really one of those states that got hit really bad in the COVID time, and it lost 60%, 70% even at times of its real estate value. And they came back hard and fast as soon as things opened, and it recouped all of its value, almost all of its value in most of these places. Tennessee, Arizona, also all of these have some examples and stories to share. So it's always about, making sure that you have made the correct investment, the right investment at the right price, okay? At the right price, and then you let it work on its own. Give it time, and it will show you the results. Okay. Okay, so well, these are actually some questions Adi was going to ask me, but so I'm a value investor. What is value investment? In very simple terms, I think we've been talking about it, and you guys have figured out most of it. But just to help you grasp this concept, this idea better, think how many of us, when we go into a store, say for example, you go to a Walmart or you go to Target, how many of you actually, walk towards the back of the store and start looking at things what are on clearance or sale? Because usually these stores tend to put all of their clearance stuff in the back aisles, all the way in the back of the store. So how many of us? Now this is something you want to ask yourself. Think about how you shop around when you go to stores. How many of us actually just walk towards the back of the store, and the thing that you're most excited about or curious about is what do they have on clearance right now? And we're going through all of those stuff, trying to see if you can get something really high quality, really good for a very cheaper price. And that is what value investment is. So, like I said, it's the orientation. If you are the type of person who actually walks into a store and goes to the back of the store because you want to see what's in clearance, and you shuffle and go through all of that stuff to figure out and see if you can find something of really high quality or a cheap price, then you are really the right personality type to be a value investor, because you're oriented like that. Not everybody does this. Not everyone is interested in the clearance. For a lot of people, clearance means garbage, and they rather stay loyal to certain brands they have, and they want to stick to it no matter the price. They'll go for it, and that's what they want to buy. So that's the orientation. I'm not saying that there's anything good or bad about these personalities. It's just the orientation of people, how we have been wired. So if you're the type of person who focuses on clearance, then you have that temperament, you have that mindset to become a value investor. Because value investment is about buying something that's worth $1 for 50 cents. That's what value investment is. We want to get really high value for a cheap price. So when we assess companies, we are looking at how much it's worth today based on its, its asset value, its earning power value, and its mode and its longevity, the survival of the mode, and all of those things going to it. But we're trying to figure out what it's worth as of today and how much are we going to pay for it. So you assess the value, and you look at the stock price to see if it is at the right price for you to purchase the stock. If not, you're going to wait for the right price. And the markets will give you a lot of different opportunities at different times to buy that stock. So there's no rush here. We're not going to lose it if you wait for a couple months. So that's what value investment is.
Let me ask you the next question, Sister Hajara. I think it's because it's pretty obvious. So, what is your okay? So the next question is, what does your day look like? Tell us how an investor spends a day.
Okay. All right, Sadia. So my day is usually filled with lots of reading. I spend a lot of time doing research. So I'm reading most of the time. I'm studying the industries. I'm looking at the different companies. I'm reading their financials. I'm looking at the 10Qs and the 10Ks, the cash flow statements, income statements. Sometimes, I try to talk to the industry experts, the insiders, people who work in those industries, to get a better understanding of, how things work there. So that's what I'm pretty much doing all day long. And if you want to be a full-time investor as well, then this is what you're going to be doing all day long. You're going to be reading and studying and getting that education and trying to, then figure out from all of that information, what's a good investment and what's a bad investment for you to make. But so I mean, if you want to decide doing something like this, then be ready to read a lot.
So how do you evaluate risks mainly when you come to investments? Like, are there any certain things that we need to consider when taking risk?
When taking risk, yeah, there's actually a lot you need to consider. But I think we have a question that sort of answers that. There is a question down in one of those slides pertaining to that concept. How do we go about investing? What are the step-by-step things to do? So maybe we could discuss a little bit more on the risk when you're on that slide.
Sure. Okay, so the next question is, for someone looking to do this, do they need a specific college degree or education?
To be an investor, no, you do not need a specific college degree. Investors come from all different educational backgrounds. We have doctors who become investors. We have engineers who became investors. So there is no specific college degree, but you need to be able to do this type of work. You should be able to understand the financial concepts. You need to be able to read about markets, about businesses, and understand what that means. You need to be able to, know how to read the financial documents, the 10Ks, the 10Qs, like we call them, are the balance sheets, the income statements, the cash flow statements. You got to be able to know how to read these statements. So accounting is important for us to know. Now, accounting is the language of finance. Okay, it's the language of business. So it's really important for us to know how to read these financial documents, and accounting will enable us to that. Now, I don't mean you need to know accounting to the level of an accountant, because we are not trying to do that here. But the thing is that when it comes to accounting and how things are reported by the businesses, there are changes that happen pretty frequently. Say, for example, there is a concept called mark to market. Previously, when businesses reported about their assets and liabilities and those kind of things on the balance sheet, they only had to report a lot of these assets at the cost price. Okay, so their purchasing price. Now, the rules have changed for accounting. They need to market every year, every reporting session, every reporting time. They have to market to market. So what does that mean? They have to look at what is the current value of those assets in the market and use that as the value. Now, there are drawbacks to doing this from the investor's perspective. Those numbers can be misleading because those numbers can be inflated based on, if there is a hype in the market, or there could be, really pessimistic numbers. So as an investor, you would have to now do your own study to figure out, what it really is worth and how much you should really be paying for something like that. But accounting changes reporting standards. Accounting changes how things are being reported on the financial statements, and that will have a huge impact on what you are going to pay for an asset or what you are going to value that asset as. So accounting is something we need to know. So education-wise, yeah, you got to do some things, but you don't need a specific college degree. So education-wise, you can learn about finance, you can learn about businesses, and you can learn about some of the basic concepts, and then you learn how to read the financial statements. As far as mathematics is concerned, you just need to be able to do the elementary level mathematics. That's all the skill you need. You don't need to do very complicated models and algorithms. They don't really work as well. So don't worry about those things, but education is going to be really, really important.
Thank you. So the next question is, how can someone start making investments?
Okay, so this is where we'll talk a little bit more in detail about, now we know what investments are. We sort of understand, what are categories, what are strategies, what are philosophies, what is growth investment, what is value investment. We've kind of, talked about those things. We've talked about the important compounding aspect of investment. Now, as an individual, if you want to do this, how do you go about it, right? So first thing you want to do is figure out what's your orientation and philosophy like, right? What kind of person you are, and how are you geared? Are you comfortable taking a lot of risky bets, or do you like to, be more calculated in your approach? You got to study yourself, okay? Be realistic about your situation and risk. Everybody's situation is different, right? You have to really look at your own situation, assess your individual risk, and then see how much you can commit to investing, right? When you commit to investing, think of those funds as the additional funds that you will not need for the next 10 years, 15 years. That's the money you're going to invest. And then irrespective of whether you're going to do this on your own or you're going to hire a fund manager or a investment manager or an advisor, know what you're buying or what they are buying for you. At least have an understanding of those businesses, of those investment asset classes. More importantly, know what you do not know. What does that mean? That means be aware of your own biases. Be really realistic about your knowledge about a certain business, about a certain industry. Just because you are an investor doesn't mean that you need to have good idea about all different industries, all different business types. You're not gonna. I do not. I'm only good in certain industries, but I don't understand all kinds of concepts. So you need to know what you're not comfortable or what you truly don't understand and stay away from those things. No matter how exciting, how trendy, or no matter how many people are talking about putting their money into those companies, if you do not understand that concept, that business, that idea, if you don't understand what that future might look like for that business, you do not put your money in it. Warren Buffett, he back in 2000, right, the 1990s, late 1990s, 2000, there was the IT boom, right? That's when, we had Microsoft reaching its highest valuation and a lot of other IT companies popping up. Warren Buffett did not invest in technology companies in that time, period. Why? When the rest of the world was doing it and they were making big money doing it. Millionaires are popping up here and there investing in technology stocks. But Warren Buffett stayed away from those stocks because he said that he'd never understood technology well. He couldn't figure out, what that value is going to be in those businesses down the line, 10 years down the line, 20 years down the line, 30 years down the line. He couldn't figure out what the moat, the barrier to entry exists around those businesses. So he didn't put his money to work. Now, you could say he missed out on, he could have made billions if he had invested his money. But he missed that boat. But, he missed it for the right reasons. He did not understand those businesses, and so he stayed away from it. So be aware of your own biases. Sometimes, we can make ourselves believe that we understand a business, an industry, because everybody else is talking about it, because everybody else is investing in it. So you have to be really true to yourself here. Other than that, you have to learn about the industry and the competition, become a specialist. Now, this is the thing, especially when it comes to value investment. Previously, like back in the 80s, in Ben Graham's days, Ben Graham is considered to be the father of value investing. Back in his days, value investing was really simple. It was always about just, buying something that was underpriced, right? So buying $1 for 50 cents. And it was easy to look for those companies. In fact, back in the Depression time period, we were able to buy stocks for, less than the working capital. That was, the current liabilities and current assets subtracted. That's the working capital to keep a business running for a year. So we have companies like that. But there is so much more competition now. It's hard for us to find those kind of opportunities. So you have to become a specialist in certain industries. What does that mean? It means increase your knowledge and understanding about some industries that you can relate to, understand better, and visualize the future for, right? So you have to become a specialist in this day and age. If you are going to do this by yourself, you have to become a specialist. Value investing is about investing in cheaper stocks. So we try to tend to look at the really ugly places in the market to find our deals. But we'll come to that in a bit. So have an idea about standard metrics and the balance sheets, and know accounting, know how to read the financial documents. So that's very important. There is no investing without that. And if you're hiring a fund manager, if you're like, hey, this is not for me, I'm too busy, I don't want to do this, then if you're hiring somebody to put your money to work for you, talk to them. Figure out what their investment philosophy is, what their approach to investing is, what returns have they achieved or, have they gained for their clients over the years, right? Figure out if their goals align with your investment goals. And then look at their fee structure. Nobody's going to do this for free, obviously. So look at how much they're charging you. It usually is a certain fee to manage the money, and then to take a certain amount from your profits. Everything that they make for you on your investment, they take a percent. So it's usually 2 and 20. So that's how we call it. So 2% of the management fee, 20% of the profit. But these rates vary. But you have to know what you're getting yourself into. The knowledge is really important for you. Whether you're doing this on your own or getting a professional help, it's still your money. So don't think that because there is a fund manager, there is an advisor doing it for you, you're in good hands, safe hands. It is still your responsibility to make sure that the right, your money is being taken care of in the right way. Your investments are being taken care of in the right way. Now, if you are someone like me who wants to do this on their own because you like the research aspect of this type of work, or you like reading and things of that sort, so there are some step-by-step things you can do here. Look at the way you want to start identifying good undervalued stocks is by looking at what's bad in the economy right now. Which industries are, suffering right now. So look at the ignored, the ugly sectors of the economy, of the market. Start there, okay? And then be aware of your stock biases. Know what your own shortcomings are in terms of, understanding a certain business. Read about the industry first. Look at what's happening in that industry, whether that industry is a viable industry, whether that is industry, so the type of industry that, does have an opportunity presented for businesses to have a moat, or what kind of industry that is. Read about the industry. Then start reading about the businesses in the industry, their financials, their shareholder letters from the management, the business reports, to figure out if, this business has a moat. Today we're not going to be able to get, into more deeper discussion about some of these other important concepts here, but most in very high level terms is basically the barrier to entry. Okay, so think of a castle, right? In the olden days, when the kings they made their castles, they usually had a moat around the castle. So the castle would be, sitting on a tall hill or a mountain, and there is usually like a water barrier around that castle. Why? To protect the castle, right? So that the enemy does not attack or sneak in easily and attack the castle. So that's a moat. So the businesses, the best businesses are the ones that have a moat, a protected moat around their business that protects their profits, that protects their earnings over long periods of time. And that is something we will have to determine whether there exists a moat and how strong of a moat it is. Some areas or some, websites, free websites, and some paid ones that you could, start reading some of these things at our Yahoo Finance, which is free source. There is one called Guru Focus. It's a good website, but it does, it's a paid subscription. And then your own brokerage account will provide you with a lot of research on the different businesses. So you will have to open a brokerage account to invest in stocks. And then there is another website called ROIC.ai. So this is also a very useful website. It helps us understand the way the return on invested capital has been changing in a business over the years. A return on investment capital is also a very, very important concept in business, and it actually helps to determine whether a business has a moat. So, a financial metric you can actually look at to determine if a business has a moat. And then, figure out after reading all of these things whether, this is a viable business, a non-viable business, whether this business is going to die down the line, whether this business is going to survive. If it's a non-viable business, then you're going to value it based on the liquidation value of its assets because, there is no future to that business. But if it's a viable business, then you're going to look at, whether there is, based on the viability of the business, you're going to do either the asset replacement value of the assets and then look at the earnings power, how much the business is earning on those assets. And then you bring in the growth calculations into all of these when there is actually a strong, significant moat. So value investors typically do not pay for growth, or at least they didn't want to, because growth is such a vague concept. It's something out in the future that only growth investors are, willing to pay for. Because it's an unproven concept, right? We don't know what that growth is going to be down the line. We don't know what that earnings is going to be down the line. So it's hard for a value investor to, just pay a price based on the expectations that there is going to be a growth, which there may not be. But because of competition, we have to incorporate growth calculations now in our assessment of these companies because there is just so much competition in the investment world out there. So when we calculate growth, we're looking at the franchise value of the business, or we're looking at how strong of a moat this business has, and then we'll try to give it a number based on the GDP growth rate of the country. Okay, so we still try to minimize our excitement about growth here in our calculation. And then you determine what you think is the right price. So I don't want you looking at, what's the price reflected on the stock market yet, but look at, what you think is the right price, how much you should be paying for this business based on all of these calculations. And then think about why you are on the right side of the trade. What does that mean? It means that, when you're buying a stock, there's somebody already selling you a stock. And you're buying this stock because you think it's a good investment, but there is another person who's selling it to you because they think it's a bad investment, a bad choice. So you gotta now validate your decision. Like, why do you think you are on the right side of that trade, right? So be very honest with yourself about these things. Have a margin of safety. Super important concept to safeguard our investment. Margin of safety. So that means, your 50 cents or $1 value is your margin of safety. We want to play safe, right? Pay way less than what it's truly worth, and because we don't know. Here's the thing. We're making all of these calculations. We're understanding the businesses and, we're trying to understand the industry. We're looking at the moats, but nothing is a guarantee here except for your asset value because the assets are actually, they exist. The business has them, right? Except for that, there is nothing else that's truly real. So it's still a risk you have to take in investing. And so margin of safety is going to be very helpful to keep your investment safe. Because like Warren Buffett says, rule number 1, never lose your money. Rule number 2, never forget rule number 1. So always remember that. We don't want to lose our money. And then finally, when you have done all of this work, that's when you start looking at what's available on Google search. What are other people saying about this business? Read the analyst report. Your brokerage account will also offer those to you. Read what the news articles are saying about this business. So try to get as much information as you can about the business, about this investment concept, about the stock. Talk to the industry people if you have those connections. The contrarians who may not be on the side of that trade, right? Why they think it's not a good investment. Try to understand their perspective. That can help you validate your own judgment here. So So these are all things you will need to do. So as you can see, it does take a lot of time. This is not something you're going to be able to do, on a part-time basis or something like that. It does take some commitment here. But if you do this correctly, it's not unheard of. It's not impossible or unrealistic or one-off to get returns like the ones we just saw with Google and Microsoft. You can achieve those results, but you will have to put in the work.
Yeah, sure. Can we go to the next question, Sister Nacho?
Yeah, go ahead, please.
The next question is talk about the Islamic perspective of doing investment. What are our choices as a Muslim investor?
Yeah, so this is one topic that I think all of us are curious about as a Muslim investor. I'm just going to go over some of the basic concepts that apply to Islamic finance. So Islamic investing, first and foremost, try to understand this. It's not very complicated. To be honest, it's not very complicated. Halal investing is pretty straightforward. And the nice thing is that halal investing is value investing. So if you look at how value investing is done and try to compare it to what halal investing is according to a lot of the Sharia books, it's pretty much the same thing to a large extent. So, I like to think that all good investing is value investing. In my view, that's what it is. So when we are trying to do investing in an Islamic way, there are certain things you want to keep in mind, okay? Whether, you're doing this on your own or you're getting some professional help. First and foremost is we want to avoid the haram industries, right? We don't want to invest in businesses that deal with alcohol, so they produce alcohol, or banking, the traditional banks, because their main source of income is the interest, the riba. Stay away from that. Companies that are engaged in gambling, weapon manufacturing, pork production, those kind of, haram products. We want to, stay away from those industries. So that, takes a bunch of different industries out of your research, your screen. Then, so according to a lot of the general consensus among the Sharia boards is that you want to invest in companies that have low debt. Now, what does that low debt mean? What is that number? It's usually less than 30% on the balance sheet. So 30% or lower debt on the balance sheet. So how do we compare that 30% of what? 30% of the total asset value of the business, or 30% of the market capitalization value of the business. So market capitalization is whatever that the business is selling for at any day and time. So some people like to take an average of those market capitalization values over a certain time frame and then determine a number. But the main idea is keep the debt low. So lower debt, usually less than 30%, 33%, but that's what we are aiming for if we want to do it from the Islamic perspective. So invest in those companies. Then invest in businesses, products that benefit the society, right? So our goal is not to invest in companies that do not truly benefit the society, the community. So speculation comes into play here. A lot of the scholars are against cryptocurrency investment for the same reason, because it doesn't serve a purpose. Cryptocurrency, according to some scholars, is considered to be like a fiat currency, just like how we have dollars, we have pounds, we have rupees, and those kind of things. So cryptocurrency is a currency, according to some scholars, but still most of them have ruled against investing in cryptocurrency because, it's a speculation, it doesn't serve it doesn't serve the community, it doesn't serve the society. And then, so when you are researching your businesses, you want to do these things. Avoid the haram industries, look for low debt companies, invest in products that are halal and supportive to their community, right, that benefit the society. Avoid speculative bets. All right, and kind of, extending that speculative bet thing, we don't do day trading, okay? So day trading is haram. What is day trading? Day trading is short-term investing. So, you are buying and selling pretty much on the same day. That's what day trading means. So day traders, they buy the stocks and, as soon as the price rises a bit, they sell the stock. So their intention is not really from an investment perspective, but it is, from the trading perspective. They're trading, basically. So that's haram. Margin trading is haram, where you are taking a loan. A lot of the brokerage accounts allow you to do margin trading, so they will lend you the money to trade. So that's haram. You have certain implications with margin trading. If things go well, it goes pretty well, but if they go bad, then you have a huge debt plus the interest to pay off to your brokerage account holder. Buying the futures. So futures are basically contracts. Futures and options are derivative contracts. Futures are derivative contracts, and so these are basically commitments that you're making to buy or sell a stock or an asset based on a certain price. So it's pure speculation here. That's what you're doing here. If the stock, rises by a certain amount, you're gonna either buy it or sell it. And so the difference between futures and options is that, futures are, one is more certain, like you're committing to actually doing it. The other one sort of gives you an option to do it. But you're still in that mindset that either you're going to buy or sell it based on a future daytime price of that asset class or asset base. Bonds are haram. The traditional bonds are haram because they give you interest as a fixed income, right? Interest is what we earn through our bonds. So the treasury bills, the government bonds, the corporate bonds, all of these give you interest as an income, and that's haram. Interest is haram. Everybody agrees on that one. Short selling is haram too. So what is short selling? Short selling is, so there is a community of investors called short sellers. What they do is they are actually betting on the downfall of a business. So according to them, a certain company is going to lose its market value, or, so the most recent example I can think of is, I don't know if you've read it in the news, but the Hindenburg research company, they released a report on Adani, a group of companies from India, and, they basically, said in the report that, they're involved in a lot of different things, corruptions and those kind of things, and so their value is not truly reflective of the business worth, and so the stock lost a huge amount of value because of that report, and they're trying to calm their investors. They're trying to sort of validate the true value of the business here and comfort their investors, and there are some big names invested in the Adani group, but that's what short sellers do. So they buy these derivative contracts and they bet on the downfall of a business, which is also haram in Islam. So short selling is haram. Buying bonds that give you interest as an income is haram. Getting involved in any kind of speculative investment is haram. And then we have all of these other simple rules. So if you actually follow these on your own, you could do this very well. You don't need an Islamic finance type of a brokerage or company to help you do this. You could actually do this on your own, and we should all learn how to do this on our own, because as a Muslim, this is what we need to do. We have to invest in an Islamic way. But it's not hard. That's the thing what I'm trying to explain it to you here. It's not hard. We can do this. It just requires a little bit of training and education, and we could do this. So the thing is that with all of this, and Islamic finance and Islamic investing has become such a big trend across the globe. And so we have all of these different companies that are coming up, fund companies that are, taking your money and investing on your behalf. And I got a chance to study some of these businesses, and what I have realized is that they're not doing any really deep, or they're not making a whole lot of effort here in terms of doing that deep research for you. Now, a lot of these businesses are putting your money in the ETFs. Okay, so what are ETFs? Electronic traded funds. These are like index funds. So what they're doing is they are investing in the stock market. Now, you would ask, if they're investing in the stock market, then they might be investing your money in the haram businesses as well, right? They're not, because they are actually segregating the halal and the haram. Say, for example, take the S&P 500. Okay, it's a stock exchange. It's a pool of companies here. S&P 500 usually has the blue chip big companies. So what these halal investing companies, what they're doing for their clients is taking the money and putting in the halal companies from S&P 500. So made an ETF and investing in that ETF. But the amount of fees that they're taking and the amount of profit sharing, I found it to be very expensive than what is being offered by traditional, mutual funds, traditional index funds. It's way, way more. And the thing is that if you do a little bit of digging and research on your own, you're going to find that there are a lot of these traditional fund companies, the fund managers, traditional mutual funds that actually have started offering halal ETFs, like S&P 500 ETFs, halal NASDAQ ETFs, those kind of things. So you don't have to invest with these, Islamic finance or Islamic investment type of companies to get get an opportunity to do, these kind of investments. You could either do it on your own. If not, then you still have an option to go with the traditional companies like Franklin Templeton. They have come out with a halal index fund, halal ETF. There is a halal S&P 500 ETF that's available through the traditional companies. And the amount of fee that they charge is minuscule to manage that fund as compared to some of the new companies that have popped up, who are marketing towards the Muslim investors. So think about this, do your research, don't rush into these. It's not that hard, it's pretty simple, and you could do it on your own. And then there is something called a sukuk, which is a Islamic bond. So this is different from the traditional bonds we just talked about that give interest as an investment or as an income to you. But the sukuk is an Islamic bond, and the difference between these and the traditional bonds is that when we deal with a sukuk, there is actually a tangible asset that is available that's used to create that bond, and then based on the value of the asset, the income you're getting from that sukuk will change, go up and down a little bit. But these are very new concepts in Islam. I apologize, in the Islamic investing. So sukuks are not all that common. It's not every company offers these sukuks, and there is a lot of issues that are happening with investments in sukuk as well. So there is a learning curve that we're sort of going through, and so I'm sure that some of these conditions are going to be refined here. But that's an opportunity for us as Muslim investors to have a fixed income source, the sukuk, because it does give out earnings to you, but based on a tangible asset, not like a traditional bond, which is basically a loan based on the risk profile of the seller. And then we have commodities that we could always invest in, which is halal, for investing in your gold, in your precious metals, those type of things. But it's a different ballgame, so you have to do the learning before you make any kind of these investments.
So the next question here is, are there any quick or easy options for someone who may not want to do any time, or who may not want to spend time in doing research?
Index funds. No other answer here. Index funds is the best option. If you don't want to do the research and you're looking for a quick option, then invest in the index funds. S&P 500 index funds. Like I said, there are halal options now with that index fund as well. S&P 500 has the blue chip companies, so it's a very good investment. NASDAQ composite, and the NASDAQ 100. I like the NASDAQ 100, which is sort of like it carves out only the technology companies from NASDAQ composite exchange, and it has created an index fund, so you could invest in those index funds. Those would be the best ones. my, if it was for me and I wanted to do something like this, instead of going with the, mutual funds or having a fund manager manage my money, I would actually invest just in the index funds, because the index funds will give you a much better return as compared to the individual return of some of these, fund managers. And there is a lot of research and proven research behind this, that investors, individual investors, retail investors are better off investing in the index funds. And as Muslims now, we have the halal option available to us as well. So do some research. You're going to be able to find a lot of information on halal index funds, and you could invest in those things. They all have a certain amount of fees. I would say invest in the ETF, the electronic traded fund. That has the least amount of management fees, only like 0.03% or 0.07%, something like that on a yearly basis. But they are the best option if you don't want to do, research and those type of things and take on as a full-time work. REITs, if you want to do the real estate investment, but you don't want to manage the real estate, so you don't want to buy a property and manage it. So REIT is the best option for those type of people, because it is a real estate investment trust. Their whole business concept is about buying properties, getting rentals, and because of the way they have been structured, by law, they have to pass almost 80% of their earnings, the rent, to the shareholder. The only problem I see with REITs is that when you get that money as dividend, you're going to be, it's not going to be at a lower tax rate, but that you're going to pay a full tax rate on that. So that's the only problem. You lose money there through your taxes. But if you wanted to do real estate and you don't want to buy properties, then REITs is a good option for those type of people. So index funds, REITs. But if you want to work with an individual, you want to work with a company, you want to work with a fund managers and talk to those people, understand what their investment style is, what their philosophies are, what their returns have been over the years, and learn about their fees. The fee structure is super important, because it will change a lot of things for you. I mean, a 6% return, if it is a 6% return for you on your investment, and you're paying 2% of the management fee and then 20% of that profit, you're not going to be left with much. So think about those things.
The next question is, what kind of returns should we realistically expect? And is there a number too good to be true?
So 8 to 10%, if you invest in the index fund, ETFs, you should probably, get about 8 to 10%. So when you invest in an index fund, you're sort of investing in the entire stock market, okay? So, you're going to average out based on what the market does in that year. So 8 to 10% is a good, return to expect in a year after expenses. And the way you want to look at your return, so, like how would you consider one to be a good return and one not to be a good return, is generally you want to benchmark it against the prevailing interest rate. So that's the risk-free rate. So that's the even though, for us, interest rate is haram, and we will not invest in those kind of products, but it gives you a benchmark to see, if I were to invest in, say, a bond, and that would be, or, a CD at a bank, that would be risk-free for you, right? You're not going to lose your money, your investment is safe, and then you're still getting a certain percentage as interest earning on that investment. So you compare it, you benchmark it against the existing risk-free rate, but on an average, 8 to 10% is a decent return to see on your investment. Now, if you're doing this full time, then as a investor or professional investor, 20-25% would be really awesome, and it's achievable. That's the thing. So I'm not, I'm not saying that it's not achievable or it's a one-off case. It is achievable. Many investors have done this over the years. 20-25% as a return on a yearly basis. Now, what's too good to be true? If someone's promising you 40%, 45% consistently over the years, then that's, heads up, be very careful. There are no such investments that can give you a consistent 45%, 40% year on year. No, that's just not possible. So that's a number you want to be wary of. You're not going to be getting those kind of returns, maybe one-off here and there, but not on a consistent basis, right? So if you're doing this alone, or if you're lucky enough to find somebody who could actually do this for you and be able to earn a 20-25% return, you're super lucky. Hold on to that person forever. But if not, then 8 to 10% after expenses is a good, decent return to expect from your investment.
I think that's the end of the presentation, and I think we can go for the Q&A. I see many people already added their questions in the chat box. So let me read them. So, do we have to pay tax on the investment income? Any type of investment that is tax exempted?
Okay, so usually when you put money in your retirement account and you invest through your retirement account, that becomes tax-free for you. You don't have to pay any immediate taxes on those funds, on those dividends. But other than that, investment itself is not going to be taxed. There are no capital gain tax unless you sell that investment. So if you sell a stock and you have made money on that stock, then you would incur a capital gain tax. But other than that, if you stay invested, you're not going to have to pay any capital gain tax for as long as you're invested in that stock, in that equity. Now, dividends, on the other hand, are going to be taxed. Okay, so it's at a lower tax rate than what your income will incur. So, whatever you're going to pay as a tax rate on your salary, it's going to be lower than that, but dividends are going to be taxed.
Okay. The next question is the inflationary pressure in the U.S. seems to dwarf savings and have reduced purchasing power. What is the reliable type of investment in the current market for the senior citizens?
Okay, so for senior citizens, it's going to depend on what your situation is. So this is very individual to everybody. It has to do with your own specific situation and the amount of funds that are available to you. Typically, when we talk about inflation, the assets that work best against inflation are, stuff like real estate and just investing in companies that actually have the capability to increase their prices as inflation rises. Okay, not everybody has that advantage, but there are certain companies that have that pricing advantage where they can increase their prices with inflation. So you want to stay invested in those companies. Otherwise, real estate is also a very good investment option as an asset class. But for a senior citizen or somebody who's moving closer to their retirement age and all, you want to save your money, safeguard your money as much as you can. So that is something you have to think really hard and careful about. Otherwise, from an Islamic perspective, the sukuk, those type of bonds are also a halal fixed income type of a investment class for you. It's not 100% fixed income like you see with the traditional bonds, but it's fairly steady. So the income you get from it is fairly steady. It's relatively low risk.
The next question is, I think you already mentioned about what is your take on investing in cryptocurrency. Right? Yeah. How about the stocks that pay dividends? Are they halal or is it considered as like an interest?
No, dividends are not interest. So dividends are not interest because it's an earning from the business that's been distributed to the shareholders after they have retained, usually they retain a part of that earning for running the business and all. And the thing with dividends is that they go up and down based on the market conditions and the conditions of the business. So you must have heard, sometimes, companies stop paying dividends, right? Sometimes they increase the dividend. Sometimes they give out special dividends. because the business has done well. So dividends are not like interest. They are not interest.
Right. Can you cancel index fund anytime, or is there any contract time?
Usually there isn't a contract, but with a lot of these funds, they let you leave the fund. If it's a closed fund, you would have to. Usually, it's like on a quarterly basis. They let you a certain percentage of the clients, people who have invested with them, leave the fund. But if you're buying the ETF from the stock market, like the S&P 500 ETF that's offered by Vanguard, the ticker symbol is VOO. If you buy something like that, then you can easily sell it anytime. It's just like buying any other stock from the stock market.
So someone asked, do the REITs buy or use interest so that they will make them haram? Or
that's actually a very good question here, because the reality is that even when we talk about the halal S&P 500 ETFs or those kind of businesses, the reality is that they're still making use of interest, right? These businesses take loans, they issue bonds, and so on the bonds they are paying interest. So that is still, it exists for all businesses, right? So how do you get rid of it? It's really not possible if you think about it. There needs to be fundamental changes, drastic changes that need to happen across the board in this world for something like that to be eradicated from the source, because there is no other way businesses can function. There is no other way they can take loans and issue bonds if they don't pay the interest. So even if you are investing in these halal ETFs, you're going to see that a lot of these businesses will still be using the loans. I mean, whether it's halal or haram, now I'm not the right person to make a comment on that, but understand that when we do these things, when we are trying to make an effort to invest in a Islamic way and have talk about halal investing, it's going to be baby steps, because Islamic finance, even though it's been something that has been talked about and researched for a good amount of time now, decades, but it's still taking baby steps, and we have to take baby steps here. So think of an example just to help you understand the situation better is a new convert. If somebody converted to Islam recently, you're going to see that they're not going to be able to follow all the rules and regulations from the get-go, right? It's a learning process for them. They have to take baby steps, right? So that's how we're dealing with things in Islamic finance right now. It's baby steps. So you're not going to see that everything is perfect at this point, but we're making an effort to do this correctly in the most Islamic way.
Yeah. Someone, Jubair, asked, her money goes into pension and 403B. She randomly picked a bunch of stocks with projected retirement rate of 25 years. Can she move those 403B to halal index fund? So before answering this question, what exactly is 403B? Sister,
so these are, I'm not an expert in the retirement accounts, but these tend to be the different fund categories where your retirement funds are being invested. So, but the thing is that a lot of times, what you see under these 403Bs and, all of these different categories is that they, again, have different mutual funds and different types of funds that they're putting a pool of money in. So it's not individual companies, but, it's a bunch of funds. So it's hard. It's hard for you to invest another way. I mean, you could talk to the brokerage company that you have your account with, your retirement account, and see if you can find if there are any halal funds that you can invest in. But, you will have to find out with them, because unfortunately we don't have a whole lot of options right now if you're doing 401ks and all.
So the next question is, and I think I will take this last one. What about the covered calls? Are they halal?
The what?
What about the covered calls? Covered calls, are they halal?
The covered call?
Yeah, I'm not sure what exactly it meant. But I think someone even asked, are there any investment brokers you would recommend in Chicago area?
Investment group?
Yeah, investment brokers that you recommend in Chicago area.
Unfortunately, I cannot make any recommendations. I would, I gave you some guidelines today to see, what works best. Look for value-oriented, fund managers. Look for managers who align with your goals, investment goals, and values and philosophies as well. And look at their track records. The thing with a lot of these fund managers is that, their track records tend to be almost similar on a year-by-year basis because, they're always trying to make sure that they're achieving at least that set percent that every other fund manager is achieving so that they don't start losing their clients. But you have to do the study here and work with somebody. I would say at least, if you can make this happen, try to work with a small fund manager, but a highly experienced, value-oriented fund manager where you could have a more, better relation with. A lot of the fund managers, a lot of people, who manage other people's money, they ideally don't like the interference from their clients, and that is correct to a large extent. You don't want people interfering in your investment work, in your research and all, but, at least if you have that rapport, then you will have a better idea of, how they're thinking about the different investment options, how they're deciding to invest in one asset as compared to another one. But other than that, I'm sorry, I don't have any recommendations that I can make for you.
I think we are at the end of the session, and it was a great session, very informative. Thank you so much, Sister Hajara. I really appreciate your time and effort in putting all this up, and thank you so much.
Thank you for having me. I hope it has been helpful to everybody here. So thank you everyone for coming and staying for so long. And then if you have questions, I'm happy to answer them. Sadia, if you can maybe just email me the questions, I'll try to respond back. These are people from one of the groups that you manage. We could all discuss with that. It just helps get the information going.
Yeah, yes, inshallah. Yeah, and thank you. And thank you everyone for attending this session. We really appreciate your time as well. Thank you. Assalamu alaikum.